Hello, everyone. I'm Scott O'Brien, Senior Manager of Finance and Tax Policy for NBAA, and thank you very much for being here for today's preview recording of our NBAA Tax, Regulatory, and Risk Management Conference, which will be held November 15th through 16th in Las Vegas, Nevada, ahead of NBAA's Business Aviation Convention and Exhibition. I'm very happy to have with me today Kent Jackson, who is the founder and managing partner of the Kansas City law firm Jackson & Wade. Many of you know Kent from his frequent presentations, and Kent focuses his practice on structured aircraft transactions and offers a broad range of regulatory advice to his clients. He's developed structures for Part 91 operations, 135 operations, public charters, so he has a great depth of expertise on the federal aviation regulations and how they apply to structured aircraft operations. So what we thought we would do today is give you a bit of a preview of the session that Kent will be presenting with Jeff Weand of Boston Jet Search on regulatory planning to achieve your mission. So if you're thinking of attending the tax conference, we hope this gives you a preview of what you'll expect to see during the rest of the 2 days. Or if you're looking to get ahead of the curve and learn a little bit more about some of the basics of the differences between Part 91 and 135 and how they apply to your structuring decisions, we hope this will help you as something to prepare for the conference. And I'm going to turn over to Kent now, who will give you the presentation.
Thank you, Scott. A key in understanding how to set up an aircraft operation is balancing the different desires that the aircraft users will have. First and foremost is managing FAA and DOT compliance. But a close second is managing state and federal tax issues, the good and the bad, and managing and understanding liability issues. With FAA and DOT compliance, there are two basic operating structures under the federal aviation regulations. Part 91 covers non-commercial operations. Part 135 governs commercial operations, and I'll talk more later in this presentation about how those two work together. Many business aviation operators choose a hybrid between the two, where some flights will be conducted under the Part 91 non-commercial rules, and others will be conducted under the Part 135 commercial rules. Next balancing aspect to look at is taxes, both state and federal. From a state perspective, we want to minimize or avoid state and local sales, use, personal property, ad valorem, and other taxes that are assessed on aircraft at the state and local level. We also want to minimize federal excise taxes, a subject that is changing as we speak, and it'll be important for all participants at the NBAA Tax Conference to catch up on what Congress has been doing in that area. And then from a federal perspective, all aircraft operators want to maximize their deductions for the aircraft, their deductions of operating expenses, their depreciation deductions on the aircraft. And many operators find that even within this single point of state and federal taxes, a decision about one may affect the other. So, for instance, a structure used to minimize state taxes may incur passive activity loss limitations on the federal deduction side. So that's a typical example of the balancing act, even on just the aspect of taxes. From a liability perspective, all operators would love to have absolutely no potential liability. For the most part, that's unrealistic. We'll talk later in this webinar about how to maximize liability protection and at what cost. And of course, regardless of the structure selected, it's vital to maximize insurance coverage. Let's go to the next slide. Each of these affects the others. And as I said, within the tax, you may even have a balancing act to perform just on the aspect of tax. It's difficult and sometimes impossible to balance all of these three key aspects successfully. Every operator comes to the table with a different set of priorities. Obviously, in an ideal world, we would get to fly anywhere, anytime, charge anybody, not pay any taxes, write off every penny, and never get sued. The accountants, the lawyers, the flight department, they have to really listen to what the people downtown want the most and balance those issues accordingly. For example, Part 91 gives maximum operational flexibility. Part 91 is the general operating rules. If an individual is a pilot, buys an aircraft, and flies it himself or herself, that's the origin of what Part 91 was for. Many business aircraft operators use Part 91 because they want the maximum operational flexibility that Part 91 gives them. With that, they have to accept responsibility for those operations, and they have to accept restrictions on reimbursement. There'll be a number of presentations at the tax conference discussing these issues in more detail, but it's important to know at the high-level view that Part 91 gives operational flexibility, but at the price of responsibility and restrictions on reimbursement. The best way to view it is that you can't accept any reimbursement under Part 91 unless you have a specific regulatory exemption to rely on. By contrast, Part 135 gives maximum flexibility in reimbursement, because when an airplane is operated under Part 135, it's being operated by an air carrier, and the air carrier can charge as much as the market will bear. But because it's a commercial operation, the FAA imposes the maximum operational restrictions on a Part 135 operation. In addition to that, there are different federal excise tax consequences for commercial operations than Part 91 operations. That will be discussed in great detail at the tax conference. Suffice it to say that the FAA and the IRS don't necessarily follow the same definitions, and what is not commercial for FAA purposes is sometimes commercial for IRS purposes. Let's go to the next slide. The basic structure of the Federal Aviation Regulations for the purposes of planning are Part 91 for private carriage and Part 135 for the type of aircraft that most corporations are going to operate for commercial. It's important to understand a change that's occurred in the last several decades within the Federal Aviation Regulations. There was a time prior to the mid-1990s where Part 91 covered private carriage for hire. So if I have an airplane and crew, but I don't hold out or advertise that operation, but someone comes to me to get private carriage, I could provide that. Many people in the industry don't realize that in the mid-1990s, when Part 119 was passed, private carriage for hire in Part 135 size aircraft was brought into Part 135, and that's why you see in the box under commercial, private carriage for hire. Part 91 includes fractional aircraft operations, which are conducted in some respects in a dual capacity by the program manager of the fractional program and the aircraft owner in the fractional program. So, for instance, on a fractional aircraft flight that's being conducted under Part 91 Subpart K, the crew will announce to the passengers who is in operational control of the flight. If the flight is being conducted by an aircraft owner under Part 91 Subpart K, then the crew will name that aircraft owner who is in charge of, so to speak, the flight. If the flight is being operated under the Part 135 rules, because the aircraft owner has elected not to accept operational control, then the fractional program operator, if that operator is also an air carrier under Part 135, will announce that the air carrier has operational control. When we talk about hybrid structures of Part 91 and Part 135, that means that the aircraft has been placed with an air carrier under Part 135 and is being maintained by that air carrier at all times, regardless of whether the air carrier is going to fly the airplane today or the aircraft owner is going to fly the airplane today. These hybrid structures are common because it gives the aircraft owner the ability to use the flexibility of Part 91 when they choose, when they're typically not carrying anyone that they would want to charge, and then have the airplane operated Part 135 for any operations where they do want passengers to pay. So that's a good example of a combination of the two structures you see depicted on the slide there. Next slide, please. Operational control is a very key concept with the FAA. The official definition is the exercise of authority over initiating, conducting, or terminating a flight. This isn't a particularly helpful definition that the FAA has given us because the key word there is exercise of authority over conducting. Because a charter customer can ask for the initiation or termination of a flight, in other words, picking when and where the airplane is going to go, but it is the air carrier in the Part 135 arena who makes a decision where the airplane can go and how that flight will be conducted, and if it will be terminated prior to getting to the destination, when, how, and why that will happen. Operational control is best looked at as who has control over the crew. It doesn't necessarily mean who employs the crew. It means who has control over the crew. So we can have structures where a crew is perhaps shared between an aircraft owner and a Part 135 operator. It might be, the crew might be employed at either employer, employed at the aircraft owner level or employed at the air carrier, and control over that crew may switch from air carrier to owner. So in a hybrid structure, such as we talked about a moment ago, on a Part 135 flight, crew would answer to the air carrier. On a Part 91 flight, the crew would answer to the aircraft owner. When flying for the aircraft owner, the crew would still have to follow the maintenance procedures of the air carrier so that the aircraft would properly remain on the operation specifications of the air carrier. But except for that one respect, the crew would answer to and be responsible to the aircraft owner on a Part 91 flight, and the Part 91 owner, as a company, would be responsible for the actions of the crew on that Part 91 flight. So that's operational control. In determining whether a flight is commercial and perhaps should be conducted under Part 135 instead of Part 91, it's important to understand whether there are any charges or any remuneration for the flight of any kind. The FAA takes a very broad view of what compensates compensation. You're going to have to edit that. The FAA takes a very broad view of what constitutes compensation. For example, in an investigation involving a company that was providing aircraft to a university for free, the FAA wanted to know where executives of the executives of the company got to sit at football and basketball games. In other words, the company was providing lift to the university for free, but the FAA felt that if the executives of the university, of the corporation, were getting to sit in the choice seats or get other fringe benefits from the university for providing use of the aircraft, in the eyes of the FAA, those might be compensation. That's an example of just how broadly the FAA can look at compensation. It does not necessarily mean a check. One of the things that we spend a lot of time looking at in the Part 91 world is whether the aircraft operation is within the scope of and incidental to the business of the operator. So in a typical Part 91 only corporate aircraft operation, we need to look at where the pilots meet the airplane. So for example, the airplane may be owned in an entity that has no employees and no business. It strictly holds the airplane. If that's the case, then the airplane needs to be leased to the company that actually is going to use the aircraft. Since we know we can't pay a Part 91 company for use of the aircraft without a specific exemption, we look for where in the organizational chart the pilots meet the airplane. Where are the pilots employed? Who is in charge of the pilots? That company is the operator. We then look to see, is the operation of the airplane within the scope of and incidental to the business of that operating company? Is the operating company using the airplane to further its own business? Is it using the airplane to further the business of another company? If it's using the airplane to further the business of another company, then the FAA may question how that's being accomplished and staying within Part 91. There'll be much more discussion of this subject at the tax conference. Let me go to the next slide. Very often we discover in looking at corporate aircraft operations that there has been some confusion about what a proper structure under Part 91 can be. So if we find an entity such as an LLC whose only purpose is to operate the aircraft for the parent company, such as you see in this diagram, that operation is not proper in the eyes of the FAA. And the reason is the FAA, unlike the IRS, has no concept of disregarded entities. In the tax world, an entity such as an LLC is disregarded, and for many purposes, we treat it as if it's the same as, in this diagram, the widget company. The FAA doesn't have those concepts. If you've created a separate entity, then you have to treat it as a separate entity for all purposes. A common misconception in business aviation is that, in this diagram, widget company can make contributions to a sole purpose aircraft operation, and that operation can provide the lift to the widget company. And that was almost inevitably created with the belief that sole purpose company is providing liability protection to the widget company. In other areas of the law, that structure would work. It does not work in Part 91 corporate aviation world. The FAA has said for many, many years that a structure like that, the operator of the aircraft would need to hold an air carrier certificate under Part 135 because the sole purpose of that entity is to provide air transportation for compensation, and the contributions that flow down from the widget companies are the compensation. There are other negative consequences of having a structure that violates the federal aviation regulations. For instance, if you went to your aviation insurance company to insure this operation and you got a standard corporate aviation policy, often called an industrial aid policy, the insurance company's assumption is that it can charge lower premiums because the passengers are employees of the operator. That's what Part 91 typically involves. The insurance company is not expecting to pay liability claims on people who aren't covered under workers' compensation. Therefore, if after an accident the insurance company discovers an illegal operation like this, they have a very good argument for getting out of coverage by saying that the aircraft operator made a material misrepresentation to the insurance company. In other words, the insurance company is going to argue that aircraft owner-operator didn't tell the truth in obtaining the coverage. The insurance company relied on that and gave lower premium cost than they otherwise would have. And many courts have accepted these claims by insurance companies and let the insurance companies avoid coverage of an accident, in effect because the insurance company was lied to. So losing insurance coverage after an accident is as bad or worse than any penalty that the FAA could impose. So those are the primary reasons that we want to avoid an illegal sole purpose structure. Let's go to the next slide. A legal sole purpose entity structure is one in which the sole purpose entity is merely an owner of the aircraft and not the operator. And so you can see that this is a pretty simple fix. We left the aircraft owned exactly the way it was in the prior slide, and we simply leased it to the widget company, and we would employ the pilots in the widget company. This is going to be better on all fronts. Although it's now clear that the widget company is the operator, it actually has better liability protection than in the prior structure because it's not an illegal operation. A very long-standing principle of the law is that if a structure is created for an illegal purpose, then all of the corporate veils can be pierced by the courts and individuals can be liable for the operations. So here, having a legal structure, although it does expose widget company to liability and responsibility for the operations of the aircraft, at least the widget company corporate veil will stand, and the individuals behind the widget company cannot be sued personally for the operations of the aircraft, and you won't have the insurance company challenges that I described a moment ago. So it's vital in all aircraft ownership and operation planning to get this aspect correct. Having a sole purpose entity as an aircraft owner is common, it's perfectly legal, it's often an advantage from a financing standpoint in that when the bank is looking at financing the airplane in a brand new sole purpose entity, there's a lot less work for the bank to do in due diligence to review the history of the entity since it has no history and has no other business. So a sole purpose entity as strictly an owner can have many advantages. It can also be a tool in tax planning, for instance, in utilizing a state tax sale for resale exemption. So although sole purpose entities are illegal as operators, they're quite common and quite useful as aircraft owners. It's a vital distinction to understand. Scott, do you have any questions about what I've talked about? We're about running out of time.
Yeah, thank you very much, Ken. That's a great overview, and I think explains how Part 91, 135 structure of your operation is critical to tax planning and is something you need to really think of up front, which is the way we've structured the tax conference. So we hope that this provides a good overview for everybody as we'll dive into more details on regulatory and tax planning on November 15th and 16th in Las Vegas. And if you have questions or want to view this complete tax conference agenda, you can visit our website at nbaa.org/tax/2015. Thank you very much to Ken Jackson, and thank you to everyone for joining us on the webinar today.